joining us on the Q4 Guide to the Markets web conference. And to those of you who celebrate, wishing you a happy Mid-Autumn Festival. I'm Grace, a client advisor from the Global Strategic Relationships APAC team. And today I'm honored to be joined by not just one, but two great speakers from our Market Insights team. Tai Hui, Chief Market Strategist for Asia Pacific, and his colleague, Kerry Craig, Global Market Strategist. It feels especially fitting that all three of us are gathering today because the Mid-Autumn Festival is all about coming together to reflect, celebrate abundance, and look ahead with optimism. And I think those are all very much in line with the themes that we'll explore during this call. So Tai, Kerry, as we enter the home stretch of 2025, your team continues to sprint towards the finish line, keeping pace with all of the market news and updates that are just coming through every day. So Kerry, do you want to give a call out to some of these that your team has been putting out for clients?
Absolutely, and thank you very much, Grace. Yeah, as a reminder, obviously we have our Guide to the Markets we produce every quarter. However, we're always providing a steady stream of information to our clients about our current views, how we see the markets, and obviously reacting to the most material changes that we do see in economies and markets around the world. So the best place to absorb a lot of that is through our On the Minds of Investors podcast, which you can listen to on Apple or Spotify. QR codes are there on the screen in front of you. But we also publish a large chunk of the slides within our quarterly Guide to the Markets every day in the morning, which you can get from the website. And then the QR code for that is right there. As well as that, look out for our weekly On the Mind of Investors blog, where we tend to cover the most topical issue for that week. As always, a good read as well. But those are the ones you really should watch out for. Thanks, Grace.
Thanks, Kerry. Definitely go check that out. And I think, really there's a very nice symmetry that we're having this call right after Mid-Autumn, as I mentioned. This is also known as the Harvest Festival in many Asian cultures. And for those of you who aren't familiar, traditionally this festival marked the full moon closest to autumn, which provided extra light for farmers to gather their crops. And I think there are really a lot of analogies here for the extended strength that they were currently in with the current economic cycle. Tai, wouldn't you agree?
Yeah, no, I think that's absolutely correct. I think it's been a very harvest or plentiful year in terms of market returns. If you look at equities, fixed income, alts, really across the board, despite a lot of noise, despite a lot of events throughout 2025, I think the markets have really delivered for clients, for investors. So, it's something to celebrate. But of course, I think the question then becomes, what's going to happen in the fourth quarter and also more importantly over 2026. So I look forward to our conversation today and really deep dive into some of these issues for our clients today.
Yeah, definitely, Tai. I think you hit the nail on the head. I think as we go through a period of abundance, naturally, this just prompts questions about, what comes next. And as you rightly pointed out, with markets performing so strongly, I think many of our clients are coming to us to ask, where do we go from here? What risks and opportunities may lie ahead? And so with that in mind, what I thought we'd do on today's call is focus on the top 10 burning questions we've been getting from clients. And I think there's none more relevant than what's happening in the US right now, given the government shutdown that's going on there. So Tai, do you want to give a few comments on that?
Yeah, absolutely. So look, we've seen government shuts down before, but it does vary in lengths and also severity. So in this case, obviously we are week 2 into the shutdown, and for the time being, it doesn't look like we're going to get a resolution anytime soon. If you look back to history, some of these shutdowns last for days. The longest one was obviously back in 2018 in the previous Trump administration, which went on for 35 days. Now, the Congressional Budget Office did estimate back then the 35 days of shutdown cost the economy around $11 billion. $3 billion of which was permanent loss in outputs because many federal workers, they were put on furlough, i.e. they're told not to work, they don't get paid, but they will be paid back once the governments reopen. And another thing to bear in mind is not all government function obviously shuts down. There are clear, essential parts of the governments like defense, like the treasury. These are the areas where the government keeps running. If anything, a significant share of the government finance or budget continues to run despite the lack of consensus in the Congress. So all in all, the magnitude of economic impact is relatively small compared to a $30 trillion economy. and the impacted workers or federal workers is around 750 to 800,000 people. Again, it sounds like a lot, but on the grand scheme of things, it's a very small proportion of the working population. But again, I think there are some differences this time round. Clearly, it's still very much a deadlock between Republicans and Democrats. It doesn't look like we will get that resolved anytime soon. That's the first point. The second point is the Trump administration is also trying to use this opportunity to reduce the federal workforce. So they're talking about those who are furloughed. Some of them may actually be dismissed. And when asked about how many people could be on the line, the press secretary mentioned thousands. Again, not great, but thousands, I think, is not a huge number that could impact on the broader economy. But of course, thinking a bit broader, not just federal workers who are on furlough, but contractors, the other businesses that could potentially be impacted in the short term. But that would be more on the small, medium enterprises. So overall, we are still watchful over the government shutdown, but I think the overall economic impact is likely to be manageable. Of course, the other aspects that we are having problems with is the lack of data. We did miss the non-farm payroll data last Friday because the Bureau of Labor Statistics was closed. And we could also miss next week's inflation data for the same reason. So I think the risk is the Federal Reserve is going into the end of October meeting with 1 month of inflation and job number missing. So I think the market's trying to find ways around it. Well, they're using the ADP private sector data to proxy what's happening with the job market. A couple of private equity firms are releasing their own estimates on the job market too. So while we may not get the official numbers, there are some proxies out there that's helping us to sort of fill the gap for the time being. But overall, I think, despite this government shutdown, I would argue that the US economy entered the fourth quarter with decent momentum. If you look at consumer spending, if you look at corporate spending, clearly there is still quite a bit of momentum going into the fourth quarter. So overall, I'm not overly concerned about this shutdown at this point, but obviously the shutdown adds to a picture or collage of picture of government policies that is introducing a lot of uncertainties to businesses and to some households in the US.
Thanks, Tai. So I think in short, there is some impact from the shutdown, but just one that we need to keep in perspective just as part of that larger picture. So maybe let's talk about something that is having a very large impact in the US, and I think that's technology. So, would you think that technology investing is doing the large part of the heavy lifting for the, strong US growth picture that you painted, or where else?
So. Yeah, no, I think so. I think if you look at the Max 7, not only they're boosting the markets, boosting the earnings, but I think they've been a really big responsible for a huge responsibility in terms of driving CapEx growth in the US. If we look at the down to the markets chart, page 35, on the left-hand side, you see the hyperscalers, how much they're investing into their AI developments. As long as they keep investing, that I think will be helpful to keep the US economy going. That said, if you look at the job market, obviously these hyperscalers cannot be hiring, millions of people, whereas the rest of the economy is in a slightly slower growth mode. I think that's why you're starting to see some softness in the job market in contrast to the CapEx part of the equation. Now, as we've argued many times in the past, the importance of CapEx is that it really explains a lot of the growth variations in the US. If you look back to the last 12 recessions in the US, 11 of them were triggered by corporate CapEx cuts or the housing market or housing investment cuts. Only one was because of consumer spending, and that was COVID. So I think understanding what companies in the US are doing right now, it's really important to help us to understand the risk of recessions. And for the time being, the tech sector continues to contribute, and therefore we still think that the US economy is likely to see a soft landing over the next 12, 18 months rather than a severe hard landing.
Thanks, Tai. And I guess guiding towards this soft landing scenario, do we think that the Federal Reserve should continue to cut rates to support that growth momentum in the US economy?
I think so. I think if you look at the September meeting, the tone of the FOMC has clearly shifted towards focusing more on the weakness of the job markets instead of worrying about the inflation impact from tariffs. Now, again, just to put this in perspective, if you look at the amount of tariff raised, from President Trump's various tariffs over the past 6 months, our estimates is if these tariffs were fully passed on to consumers, the net impact on inflation will be about 1.4 percentage points. And intuitively, if these tariffs are split 50-50 between consumers and supply chain or the importers and retailers, then consumer price will rise by about 0.7% or 0.7 percentage points. So in that sense, I think the inflation risk is not over. But with the Fed now thinking, well, tariffs is a one-off thing and we don't really have a means to cool it down, we should spend more time thinking about the job market. I think that shift in the mindset means they are likely to cut rates another 25 basis points in October at the end of this month, and then maybe one more time in December. Now, as I mentioned earlier, we are flying, half blind at the moment with a lack of official numbers. But if you look at the ADP number that came out last week, again, weakness in the job markets. I think companies are slowing down their hiring. We're seeing a softening on job opening from the jobs data as well. So I think all of these suggest that the Fed is doing the right thing in slowly taking away those interest rates in order to give the economy a little bit more of a breathing space. So, of course, if we get even weaker numbers, not necessarily get 50 basis points, but I think you're going to see consecutive rate cuts going into the first quarter, even the second quarter of 2026. So I think from that perspective, I think the rate cut cycle is increasingly entrenched, and you see that again being reflected in the futures market as well as the OIS markets.
Thanks, Ty. So maybe switching gears and looking at China. Now, 2025 is a pivotal year in China's policy cycle. So what should we expect from China's new 5-year plan, and how do you think that's going to impact global markets?
Yeah, no, thank you, Grace. That's a great question. I think China, look, we've had a great year in terms of the markets. If you look at the Hong Kong market or even the Asian markets, China has been the surprise package. There's been increasing discussion of whether international investors are coming back into China. But of course, we have to go back to the macro economy. And frankly, some of the challenges that we've seen in the past 3-4 years continues. The property market is still in correction mode. We're not seeing much stabilization there. The job market continues to be challenging despite more spending on AI. Again, just like the US, a lot of these is capital spending, not necessarily hiring millions of graduates. So I think some of these difficulties in the Chinese economy continues. But if you look at the short-term policy intention, it does not look like the government is going to cut rates or step up fiscal spending in a material way to bring growth back. Sure, they are spending more to encourage consumers to spend on holidays, which still towards the tail end of the National Day Golden Week holiday. There is a bit more stimulus there, but supporting the housing market, supporting the broader economy, I think you're going to see very measured policies when it comes to fiscal or monetary. But Grace, you touched on a couple of really important points. Structural shifts in China continues. What you see on the screen right now is the so-called anti-involution drive, which essentially means the government is understanding there's excessive competition, unhealthy competition that is competing profitability away, and they want to correct that. Now, we saw something like this back in 2015, 2018 with a lot of the commodity producers, and you can see it worked to a great extent where PPI was rebounding and profitability improved. This time around, there's a lot of emphasis on, for example, the electric vehicle sector, renewable sector, which do suffer from excess capacity and excessive competition. but also in other areas like food delivery. So the question becomes, how can these industries or sectors go back to a more sensible, healthier level of competition instead of just competing away the profitability? I've got some skepticism because ultimately it's to do with the lack of final demand. So you can squeeze one part of supply chain, aim to improve the profitability, but someone else is going to pay for it, right? If you think about an EV supply chain, very simply put, you've got a raw commodity, you've got batteries and all the different parts of the car, you've got an EV maker, you've got the consumers. You may be able to expand profitability, say, for example, the commodity producers, lithium producers or miners. But does it mean the battery maker is going to pay more for more expensive lithium? Is it going to get passed on to the EV maker? Is it going to get passed on to the consumers? Someone's going to pay for it. So I think, the intention is correct, but I think the policy outcome will require active management to understand which part of the supply chain is going to benefit, which part of the supply chain is going to pay for that someone else's profitability improvement. And then, last point on your question, the 5-year plan. So the party is going to host its fourth plenum on October 20th to 23rd. And obviously the key focus this time around is the end of the 14th 5-year plan and the start of the 15th, which will run from 2026 all the way to 2030. And I think, what we could see is a couple of big direction, well, not shifts, but ongoing developments, for example, how to enhance global trade from China's perspective, especially with a rise in protectionism around the world. How do they improve their the independence from imports of critical components, whether it's raw materials or electronics, semiconductors, how to enhance the service sector, how to develop the financial resiliency. I think all of these is going to be part of the 5-year plan, which it does create potential new opportunities for investors in China, who I think are paying a lot more attention in 2025 on some of these structural shifts that we see in China today.
Thanks, Ty. I think if we zoom out from China a little bit and just think about the region as a whole, it's not just the US that has that tech growth theme, Asia as well, right? So can Asia's technology-led export performance continue as we head into the new year?
I think so. I think there's still a very constructive outlook for APAC exports or APAC tech exports. First of all, you saw earlier on, the US hyperscalers companies are spending more in developing the data centers, in developing the AI models, and there will be demand for hardware. And not just the hyperscalers, but for a lot of companies, including financial sectors like ourselves, we are investing a lot into AI, and that will require more processing power, and that will directly feed into markets like Taiwan, like South Korea, like Japan. And not to mention that in the case of China, if you look at what's on the screen right now, on the left-hand side, the gray bars is the top 5 companies in hardware and IT equipment. Obviously, they need to spend more to produce. But if you look at the green bar, which is top 5 companies in software and IT services, these are mainly Chinese companies. I can't name names, but you know who they are. These are the internet giants that everyone's very familiar with. And you can see they're also stepping up their spending. So, while they may not be spending $350 billion a year, but that increase in spending will create additional demand for hardware. And that, again, is likely to come from, well, where else, but from Northeast Asia. So I think from that angle, we still hold a reasonably optimistic view on Northeast Asian markets when it comes to exports, and that often explains a huge part of APAC earnings per share growth over the cycle. So overall, despite really strong performance from Taiwan, from South Korea, from Japan year to date, we think there's more to come from an exports perspective.
Thanks so much for painting the picture for us, Ty. Carrie, don't think I've forgotten about you. Let's turn it over to you for the next set of questions. I think I mentioned tech more than a few times on this call already. So I think that really speaks to how front and center this is as a theme for equity markets and investors over the past couple of years. Is tech still the only game in town, or are there other compelling opportunities that we're seeing in other parts of the equity market?
Thanks, Grace. I mean, yeah, the movements in the sort of AI-related names, particularly in the US this year, have been remarkable given the sell-off we saw back in April after that Liberation Day announcement and then the rebound since. I mean, there's a lot around how much enthusiasm has been built into the market versus what has been the reality. And then, more recently around how this expansion is being paid for. I think the chart on the left-hand side of the page here just shows you the rebound in valuations that we've seen for those top 10 mega cap name stocks in the US. It does look like they've regained a lot of that lost valuation, but depending on the metric you look at, if you're only comparing the current valuations to the last 5 years or maybe even 10 years, the valuations aren't stretched by any means, but they are certainly moving up there. The worry for investors is that this has been a relatively narrow rally in the US and that, maybe things could be susceptible to a sell-off because, high valuations come with high expectations. So far, those expectations are being met, though. So if you take the chart on the top right-hand side, you can see the earnings growth from those mega cap names, are delivering double-digit growth so far. They did so in the second quarter earnings season. As we enter the third quarter earnings season in the US, they're likely to see that again. And they're outpacing what you see in the other sort of 490 or so names in the US market. So that AI secular theme is one we still believe in. How we would think about playing the market, though, is just broadening out throughout the value chain for that AI theme. So it's not just those hyperscalers. It's thinking about all the inputs that go into that. It's considering, the industrials in terms of the hardware build out that goes to that, the utility companies in terms of the energy supply and water supply that's needed for that, as well as thinking about the eventual end use in businesses or consumers, because it's still relatively low on the adoption scale for many industries. So, we do believe there's more to go in the tech theme. We do think it's something that's secular, but we're also very much aware that you've got a wide dispersion occurring in the US equity market when it comes to valuations. And that does, present an opportunity for a much more active approach to the market and thinking about those things that may have been mispriced and left behind, or, may benefit from some of the other themes that we are seeing play through, such as further deregulation around the financial markets, which would lead into, quite a positive position on banks and financials, or just thinking about, an economy that is continuing to expand and seeing those little bit better growth come through, particularly around some of the consumer names, how resilient consumers have been in the US. So attitudes towards the US market and tech still runs that are quite constructive on the outlook. We are very mindful of the potential for some disappointment given how much valuations have moved, but we believe the earnings numbers are really there to support that. But we are looking for broader opportunities within the US market around growth names, around value names, just to really illustrate that this has been a market that's run hard. And so we would think about, being a bit more bottom up in the outlook from here.
Thanks, Carrie. I think, the common thread I picked up from what you and Ty have said so far is, the picture that's in focus is quite bright, but at the periphery, there are a couple of creeping uncertainties that might be on investors' minds. So then given some of these macro uncertainties, are you seeing investors demanding a higher term premium in fixed income?
Yeah, it's a market that you're seeing a challenging one for when it comes to thinking about the fixed income market and bonds overall. I mean, one of the biggest risks out there to the macro outlook and the sort of relatively constructive narrative that we're being painting is that, inflation returns. Ty sort of outlined how you could see it come back through the US. It's still a little bit high here in Australia. You could start to see it feed back in if you do get that tightness in labour markets, maybe leading to wage growth. It's not something we're really focusing on, but it is one of the risks out there. And so if we do think about the potential for more inflation, investors are being a little bit more hesitant to go longer down the duration curve and thinking about building that into a portfolio. They're also thinking about the sort of consequences of other factors. So if we do think about some of the fiscal policies being announced, the inflationary consequences of those in the long term, all that suggests that longer term dated yields could stay higher for a little bit longer. And therefore we think about the shift in monetary policy being one for easier interest rates and so lower interest rates. that longer end of the curve being more reflective of thinking about the inflation outlook and growth that's been a bit better. So that keeps yields curve steep, or if not steepening a little bit further from here. On the left-hand side of this page, we look at the spread between the 30 and 5-year government bond in the US. And you can see it has moved up quite a long way. And that does look like quite an aggressive move. But if you look at the average over that period, that's since January 1990, it's only about in line with average. So it does look like a sharp move in the real context of where we have been recently, but historically yield curves are only around about their average. So there is still further room for them to steepen as we see the more policy sensitive short end of the curve come down in line with central bank policies, but the longer end being a little bit more reflective of that inflation outlook, maybe some of that policy dynamic and fiscal policy that's coming through. And that does mean that we think about, being more shorter term in the duration exposure that we want to build in portfolios. And in fact, this is probably getting back to something that's a little bit more normal in terms of where we have been since 2008, right up to COVID. It was about inverted yield curves, it was about flat yield curves. And we're kind of going back to something that would be considered a little bit more representative of positive growth, positive inflation, and thinking about the shape of the yield curve being a little bit steeper. But that steepening is something we expect to continue to happen. And it does mean that investors, are demanding more to lend money to governments without questioning some of those policies in the long run. But it doesn't mean there's no opportunities in the core government bond market. And I think there is a case for building in a bit more duration, but mainly focusing on the shorter end of the curve.
Thanks, Kerry. And, maybe sticking on the topic of fixed income, you mentioned earlier a little about equity valuations. And I think a lot of scrutiny has also been over fixed income valuations, specifically corporate credit. Do you think corporate credit spreads can continue to remain at the current very tight level they're trading at?
Yeah, absolutely. I mean, I just put this chart on screen really to illustrate this one from our daily guide and also from the guide to the markets. Just shows you where current fixed income spreads are across the sort of whole spectrum of fixed income risk. And then how they compare to their average or how they've traded over the longer term. And you can see those diamonds, which represent where we were at the end of the quarter, pretty much right in the bottom of those ranges. So, spreads across most parts of the fixed income landscape are at the tightest they've been for a number of years. Now, again, this is not unusual, given there has been a relatively stable view of the health of corporate America. That does mean that the credit risk wasn't seen to be that high, that lending money to governments was maybe a little bit more risky, and lending money to companies seemed like a better option, especially when you're picking up a little bit more yield and income off that strategy. And really now is the case of thinking, well, maybe spreads can't really tighten too much from here, but what would really cause them to widen out in a big way? If we do have, an economy that's expanding, an inflation outlook that may be going up, but we're thinking about policy being easy on the monetary side, and we think about earnings that are still being quite positive and generally corporate fundamentals being quite healthy, there's not a lot of reason there to see spreads widen out aggressively, but it does mean that more of your total return is coming from that coupon, that yield, than thinking about further capital appreciation. So just mitigates much of the way we looked at the equity market, that valuation, taking off some of the expected return, particularly on the investment grade side. You can move a little further along the spectrum though, if we look at things like high yield, default rates in the US high yield market, 1.4% last month, still very low. Those same ideas around the corporate health, the low leverage ratios, the relatively high interest coverage ratios, all positioning quite well for an asset class that gets you around about 7% yield at the moment. So that carry that you can earn there is a nice complement to thinking about, having some of that core government bond exposure at the short end and really barbelling the fixed income market at this opportunity. But again, it's going to be more around the income than capital gains, given those spreads have been very tight. But it's important to also think about overall balancing out some of what would be that positive attitudes towards risk in a portfolio, and particularly protecting against downside shocks to growth that could materialize if you did see some further dynamics on the policy front that could upset that, again, constructive outlook that we have.
Thanks, Kerry. Yeah, it's all about building in those stabilizers into a portfolio. And, I think, as you pointed out, fundamentals still look fairly supportive. But given where valuations are, we might see some potential short-term pullbacks or corrections in the market, especially given a few of those peripheral uncertainties. So in that sort of environment, what kind of alternative asset classes could investors tap on just to build in some of that resilience and stability into portfolios?
I mean, it's a great question, and then it's something we're seeing more and more of in terms of appetite from investors. Some of that reflects some of the access that's becoming a little bit easier. I mean, alternative investments for a large part of time were, the remit of institutional investors, which had, less issues around liquidity. The buy-in or access was a little bit higher, so it was a little easier for them to do. And now you're seeing more on the wholesale side of investors move in this direction because they're looking for those things that they can't find as adequately in the public markets as they had in the past. So they're looking for ways to further diversify those diversifiers on the fixed income side. They're looking for ways to build in income as they think about interest rates coming down and lower cash rates. They're also looking at ways to increase that growth and that alpha from portfolios as they think about high valuations in the public market. So I think this is a very nice chart from our guide to alternatives and also on the guide to the markets that just really summarizes that. Here we have the horizontal axis looking at the correlation of these assets to the 60-40 portfolio, and then on the vertical thinking about their total return over the last 10 years. The size of the bubble here represents the income generation from those assets, but I think about it relatively simply. You can just sort of run a line down the middle of the page and think about everything to the left, this kind of blue bubbles. That's the thing that provides you income and diversifies against that 60-40 portfolio. Those are the things you want to lean into if what you're missing from your portfolio is adequate diversification, or if you're thinking about how to build that extra diversification in and get that income from component coming through. So it's infrastructure, it's transports, things that aren't necessarily as correlated with the direction of the economy because they're fundamental to the operation of the economy. We've also got a bit of real estate there as well. That's an area you've seen a lot more interest in, particularly in the US. Whereas on the other side of that chart, you're thinking about those things that deliver growth. There is private credit here in terms of direct lending where you get that income coming through, but we've seen a big resumption in activity in the private equity market with IPOs, M&A activity picking up. We're seeing that feed through in terms of attitudes towards a better outlook for private equity as well, both the primary and in the secondary market. So another way to add in more income or alpha generation and growth in a portfolio. However, this is just one way to think about added diversification. We touched on the US and thinking about that market. There are other markets around the world that we like that I may have skipped over briefly there. You can look back and see what's happening in Europe and see the outlook there for being quite positive. The fiscal support coming through there in terms of the recovery fund, or even the added fiscal support you're seeing coming out of Germany, and thinking about the opportunities that present themselves in a market where you do have a relatively strong valuation case for Europe compared to the US. It's a similar situation we touched around, or Ty talked quite appropriately around what we're seeing in the Asian tech story. Very much a positive in terms of the performance of emerging market assets this year. Emerging market equities up 30%, just looking at the local MSCI index. But it is about, those value up programs that you're seeing come through both in Korea, a little bit in China, that changing attitudes towards shareholder returns, and also in Japan, another area we've seen relatively attractive valuations. We're seeing, potentially more on the fiscal side of things now that we've had potentially a change in leadership at the LDP and in the Prime Minister coming in the election, as well as thinking about stronger earnings growth out of that part of the world as well. So globally, there's a lot more alternatives to the US equity market as well in terms of where you can go for growth in this area, I'd say, Grace.
Thanks, Kerry. I think that's a great summary. I think, in terms of conversations we're having with clients as well, they are also looking at that diversification across markets with equity markets, as you mentioned. And for those who can expand their toolkit into alternatives, they are turning to some of those asset classes you mentioned for that alpha, for that risk diversification, for that income stream. So definitely, I think all part of that consideration set as we enter into some of the asset allocation conversations into year end. Maybe Ty, putting it back to you, as we think about asset allocation in 2026, we've touched on quite a lot of the opportunities, maybe some of the risks, but what's really on your watch list and what should be on our clients' watch lists as they look at balancing between some of these short-term potential corrections and this continued desire for medium-term market participation?
Yeah, thanks, Grace. Look, we will be working on a 2026 outlook. That should be coming out in the middle of November. But obviously, we're not that far off into the production or the planning stage. Maybe we start off with just a big picture, the macro backdrop that we discussed, combining what I mentioned at the start and what also Kerry mentioned in the asset allocation discussion. We are in a world where the Fed is cutting rates. We feel increasingly confident the Fed will bring rates at least back to neutral, maybe a little bit more. And at the same time, the US economy continues to expand, albeit at a slower rate, but still in expansion. So this is a point that we've been making for the last 3 months. When you've got that combination of rate cuts and a soft landing, typically this is good for risk assets. If you look at the chart on the screen right now, which we have reintroduced into the Guide to the Markets Asia, you see that on the left-hand side in equities, a lot of those blue dots representing soft landing and a Fed cut, or the 12 months return after the first cut, typically these are positive. Of course, not every time it works. When you have a hard landing like 2001, a dot-com bust, or 2008, the GFC, the global financial crisis, obviously equities had a really hard time. But we don't think we're in that kind of danger at this point in time. So in that sense, I think the first point is we have to stay invested, and also with a diversified portfolio of stocks and bonds. As Kerry mentioned, fixed income generates that income return, albeit the capital appreciation, whether it's from government bonds or from corporate credits, is already quite limited. But 4% for 10-year, 6 to 7% for high yields. These are reasonably decent level of income to generate. For equities, sure, US equities may look expensive, but this time around, at least the mega cap, the Max 7, they're still generating strong earnings. I think that to us, it will continue to underpin the performance. But again, Kerry rightly mentioned, there are other opportunities beyond AI, beyond technology we're looking into. So I think that the first question is the macro backdrop. The second question then becomes, what are some of these areas that investors are not fully appreciating right now? I think one of which, just echoing what Kerry said towards the end, is the improvement in corporate governance across Asia. Japan has been leading the way in the last 10 years. Korea is moving quite quickly. China, again, not just the private enterprises, but state enterprises, both of which are also giving out more of their earnings to investors. They're buying back their shares, which frankly, in the case of China, share dilutions have been a huge headwind for earnings per share for a long time. Is that going to reverse? So I think, there are many of these longer-term structural factors at play. I think investors need to think about. As I said at the start, 2025 has been a hugely busy year for us with a lot of headline news. I think one thing, Kerry and I and Market Insights team in Asia and across the world, we've been busy with is trying to separate the noise from the signals, or the signal from the noise, because there's a lot of headlines that can be misleading and frankly a red herring, which doesn't really have investment implications, but there could be some understated developments that's not in the headlines that actually we find very meaningful. So I think, the benefits of us working as a team is to be able to discuss and dissect what are the noises in the markets, which we can set aside, but what are some of the underlying currents that we think are really important in helping our clients to come up with their portfolios.
Thanks, Ty. And I think, really, I couldn't have summed it better than what you said earlier, which is, it's all about separating the signal from the noise. And there sure is a lot of noise out there in the market. And I think, what you've shared today hopefully has helped our clients to think a little bit more about their asset allocations and decision-making when it comes to their portfolios amidst everything that's happening in the markets and in the world around us. So with that, maybe we'll wrap up the call. I think, thank you all again for joining us on this quarterly session. We hope you found all of the insights that Ty and Kerry shared valuable. And with that, we'll see you again, hopefully in the next quarter. Thank you so much, Ty and Kerry, for your time.
Thanks, Kerry.
Thank you.
Thank you.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase & Company and its affiliates worldwide.